The business of sea and air transportation is international in nature, involving the movement of passengers, mail, livestock, and cargo across many countries. Because this operator earns income from multiple jurisdictions, it is often difficult to identify exactly how much income is derived from Malaysia. To address this, the Income Tax Act 1967 provides special rules under Section 54 specifically for non-residency and air operator. Under this provision, Malaysia does not tax the operator based on normal business profit rules. Instead, income is taxed using an outline apportionment method based on the ratio of uplift passenger or cargo loaded in Malaysia to total uplift worldwide. This method ensures a fair, consistent, and practical way to identify the taxable portion of global income. Likewise, expenses are also apportioned using the same uplift ratio and often require verification through a ratio certificate. These special rules ensure that taxation is equitable, administratively efficient, and aligned with the international operation of airline and shipping companies.
For my part, I will explain the basis of taxation and some important definitions relating to the taxation of sea and air transport businesses in Malaysia. Firstly, the basis of taxation depends on whether the operator is resident or non-resident person. The resident person is taxed on work income basis. This means the earned income from sea or air transport is taxable in Malaysia, regardless of where the income is earned or derived. For example, if the shipping or airline income is earned outside of Malaysia, it will still be subject to Malaysian income tax.
On the other hand, a non-resident person is taxed based on the derivation basis.
This means there are only tax on income derived from Malaysia, specifically income from outward shipment of passengers or cargo from Malaysia's port or airports. It is also important to note that under the Income Tax Act, the transporting business is treated as separate sources of income. Next, I will explain some key definitions. A Malaysian ship refers to a seaborne ship that is registered under Merchant Shipping Ordinance 1952. However, not all vessels qualify. Certain types of vessels are specifically excluded, such as ferries, barges, tugboats, supply vessels, crew boats, dredgers, and fishing boats. These vessels do not enjoy the tax exemption given to Malaysian ships. Another important term is casual cost. Casual cost occurs when a ship or aircraft makes a one-time visit to Malaysia within 24 months period by ship or aircraft operated by the same operator or charterer. Income from casual cost is generally excluded from taxation for non-resident operator. Lastly, the third person under the Income Tax Act is broad. It includes not only individuals and companies but also partnership as provided under Section 54A subsection 6. In summary, understanding the resident status, basis of taxation, and this key definition is essential before determining how income from sea and air transport is taxed in Malaysia.
Next, I'll explain how Malaysian tax treats resident transport operators under Section 54 and 54A. First, Section 44 says that resident persons who earn income from transporting passengers or cargo by sea or air are taxed based on income wherever it arises. In other words, residents are taxed on worldwide income, not just income earned in Malaysia. Also, profit from shipping or airline operation are treated as a separate business sources. This means that for tax purpose, we calculate the tax on these transport profits independently from other business income, which can affect overall tax planning. Next, Section 44A provides a specific tax exemption for qualifying resident operators. If the activity meets the criteria, for example, transporting passenger or cargo on a Malaysian ship or letting a Malaysian ship on charter, then 70% of the statutory income from that activity is exempt from tax. Practically, that means only 30% of the statutory income is subject to normal tax rates, offering a significant tax benefit to eligible operators. For example, let's say that adjusted profit from shipping is 100,000. Applying the 70% exemption reduced the taxable income by 70,000. So the company would only pay tax on the remaining 30,000. This incentive is designed to encourage local shipping and airline activities, supporting Malaysia's transport industry while providing a clear tax advantage to resident operators. A short historical note. The exemption used to be 100% before the year of assessment 2012, but the Finance Act 2012 reduced it to 70%. This change slightly reduced the tax benefit, but still keeps the incentive meaningful for resident transport operators.
Next, I will explain the extension of the 100% income tax exemption for income derived from letting out Malaysian ships on a charter basis. To continue support Malaysian shipping industry, the government introduced the 100% tax exemption through several income tax exemption orders. For year assessment in 2012-2013, a 100% exemption was granted under Income Tax Exemption No. 2, Order 2012. This exemption was extended again for year assessment 2014-2015, followed by another extension covering year assessment 2016-2020 under Income Tax Exemption No. 2 Order 2018. Subsequently, the exemption continued for year assessment 2021-2023, and most recently, it has been further extended to year assessment 2024-2026 under Income Tax Exemption Order 2022, subject to the same conditions. Overall, these extensions demonstrate the government's consistent effort to promote the use of Malaysian registered ships and strengthen the local maritime industry. However, this 100% tax exemption is not automatic and is subject to important conditions under Income Tax Exemption Order 2022. First, the company must incur an annual operating expenditure of at least RM250,000 for each Malaysian ship. Second, the company must employ at least 4 shore-based full-time employees, and majority of these employees must be Malaysian citizens. Third, the ship personnel must comply with safe manning certificate requirement, ensuring that the vessel is adequately and safely manned in accordance with maritime regulation. These conditions are imposed to ensure that the tax incentive genuinely benefits the Malaysian economy by encouraging local employment, operational activity, and complying with safety standards.
Next, I will explain the key tax treatment for Malaysian ship income under Public Ruling 10/2012. Focusing on separate accounts, capital allowance and exempt income, operators or charters are required to maintain separate income for each Malaysian ship to ensure accurate reporting. And capital allowance are deemed to be claimed from the year of assessment 2009, even if they are not elected. Any balancing allowance is deductible only against exempt income from Malaysian ship, while balancing charges are restricted, so they do not exceed the total capital allowance previously given. Exempt income from Malaysian ship operations must be credited annually into an exempt income account, and dividends paid out of this exempt income are exempted in the hands of shareholders. However, under the single tier tax system, further tier dividends are no longer exempt. Under Public Ruling 10/2012, Malaysian ship income is granted 100% exemption of statutory income, subjected to specific rules. Income from all Malaysian ships is treated as a single source, and any unabsorbed loss or capital allowance may be carried forward, but can only be offset against future exempt income.
For non-resident operator, under Section 54, Subsection 2, Subsection B, tax is imposed only on income derived from outward shipment of passenger or cargo from Malaysia. any income earned outside Malaysia is not subjected to Malaysian tax. There are two methods available to determine the statutory income of non-resident operator. The first is 5% method, where 5% of the gross earning from outward shipments is taken as a statutory income and taxed at the prevailing corporate tax rate, 24%. The second one is the ratio certificate method, which calculates taxable income based on the proportion of worldwide income attributable to Malaysia. Under ratio certificate method, statutory income is calculated using the following formula, which is adjusted worldwide income divided by gross worldwide income multiplied by gross Malaysian income. Capital allowances are also allocated proportionately using the same ratio. Any unabsorbed capital allowances or losses may be carried forward to the future year. However, the method excludes transshipment income and casual costs, as these are not taxable in Malaysia. The non-resident operator are allowed to choose either the 5% method or the ratio certificate method, provided that ratio certificate method is acceptable to the Director of Inland Revenue. If the 5% method is initially applied, but ratio certificate is later submitted, a revised assessment may be made. This revision must be done within 3 years after the end of relevant years of assessment.
In conclusion, the taxation of sea and air transport in Malaysia is based on clear rules that depend on whether the operator is resident or non-resident and how the transport activities are carried out. Resident operators are generally taxed on their worldwide income, but they are given significant tax exemption for income earned from Malaysian ships. These exemptions show the government's effort to support and encourage the local shipping industry. At the same time, operators must follow specific requirements. Overall, this tax system aims to provide incentive while maintaining fairness and proper control, helping to ensure the growth and sustainability of Malaysia's sea and air transport industry.